Testing, testing. chain. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The market's playbook is finally here. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like the razor blade. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk's eye. Options and plays in a live display. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk's eye. Options and plays in a live display. Every move counts in the game they play. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like the razor blade. This is where the big plays are made. Oh, step by step they break it down. No confusion, no spinning around. With every trade they set the tone. Making big calls on their trading throne. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like the razor blade. This is where the big plays are made. Oh, this is where the big plays are made. Oh. Opening playbook, we're ready to roll. Daily moves that will fire up your soul. Strategy sharp like the razor blade. This is where the big plays are made. Oh.
All right, folks. You should hear me starting now. Give me a yes in that brand new chat box that we are working on here. If you can hear me, if I'm coming through loud and clear. Beautiful, beautiful, beautiful. All right. Thank you, everyone. Love to see it. Doug, Jack, Jason, Edward, Dennis, Nick, Joseph, Shirley, Brandon, Ted, Francine, Len, Bernard, Lisa, Hal, Kevin, Dave, Kathleen, Christine, Sheena, Debbie. I see all you. Rock. Hey, Joel. Okay, beautiful. Love it. Love it. Love it. All right. Hey, Jay, welcome in. Wreck-It Ralph says 93 degrees in Galveston, Texas. Wow. It is actually cooling off a little bit here. This weekend, you guys know I was out Thursday, Friday, and over the weekend, I was playing in our member guest at my club. And it's been like literally 90 degrees all day, every day for 2.5 months with about 1 mile per hour top winds. And boy, did I luck out. We literally got like 76 degrees with a slight breeze for 3 straight days for the first time all summer. So it was awesome. We had a ton of fun. We won our flight, and then I choked in the playoff in front of the whole club. So that was unfortunate way to end, but still made some money. Okay, so some of you, Dave, you might need to keep throwing some announcements out there for them to use those toggles because it seems like a lot of people are in there. They have the chat, but what they don't have is probably clicking the play button or flipping on their sound. So Bodine and Green and some of the others, you have to kind of get in the habit of using those video controls. All right. Yeah, the default there should be that low latency option. That will help you. Let me add Graham into the mix. Hey, Graham, how's it going?
Hey, going good. Can you hear me?
Yep, loud and clear. Sorry, we left you in the backstage there for a minute. Oh wow, why does Graham get a nice full
Nate.
label with his last name and I only get Nate?
I'm not sure, but I need to get my volume off. I'm just echoing like crazy. I'm gonna mute it.
Yeah. All right. Lynette says looking good.
All right. Can you hear me?
Yep. And Catherine, 4 a.m. Wow. 4 a.m. Catherine's coming in.
Now I can detach the chat.
Yes, we can. You guys can detach the chat. You can do a couple other options there. Guys, obviously, just bear with us here as we are testing a brand new platform. Now, I promise that we are not just testing a platform to mess with you guys. There are some big advantages that we're hoping to roll out here, things that we can do from the content side, the sharing side, that this platform will hopefully enable us to do. Ultimately, give more value. So we're planning on doing a lot of things, but obviously we have to get through a little bit of the testing phase here and the optimization phase. So bear with us. But there are some cool things you can do already. A really nice full screen menu here. The chat is a little bit easier to see and pin or open in a different window if you want to have that in a window and your screen in another window and some things like that. But the real benefit you'll see later on. All right. Cool. So now let's start. If I flip this forward, you guys should now see our agenda on the screen here. So today today is a deep dive into debit spreads, how they work. I'm going to give you some actual live trades in multiple different brokers so you can see how they actually are executed, understanding risk exercises and expirations, early exits, should you use a stop loss, and more. So we've got a lot to cover. But first, let me just confirm that you guys actually see my screen flipping, and you now see the slide that says today we'll cover with all those bullet points that I just mentioned. Is that screen flipping and coming through clearly on you guys' video? Yes, yes. All right. Perfect. Beautiful. All right. Well, good. Well, it looks like we should be rolling then. And yep. Okay, cool. All right, guys. Well, let's jump in. So I'll just give you the quick preface that I personally think that this training is probably the most foundational, fundamental training to the way that I do things. A lot of what Graham is doing falls in this category of how these kind of trade structures actually work, the benefits of them, why we use them versus regular options. And so what I'm going to try to do today, I'm going to try my very, very best today to give you guys both the conceptual framework so you understand, the advantages and the conceptual idea of trading this way, and then also get into the very practical benefits of trading this way as well. So that's what we're going to do. I hope this is beneficial. If you guys have never kind of gone through the deep dive of how these debit spreads work, then I recommend you take notes or simply join Opening Playbook VIP for $1, because then you'll get the the slideshow presentation and all that sort of stuff with it as well. So let's go ahead and dive right in. I'm not going to pay as much attention to the chat over the next 40 minutes or so here. I'm going to mainly focus on the presentation itself, and then we will dive back into the chat later, but I'll try to keep somewhat of an eye on it in case anything goes awry as we're testing the new platform. And I'll let Graham jump in if anything's broken or not coming through. All right, so what is a debit spread? A debit spread allows us to take a trade with less overall risk and a higher probability by simply buying and selling an option at the same time. Now, anytime we trade a debit spread, we are creating what I call a line in the sand. So that's a strike price, that's a certain price on a particular stock at a particular time. And that's where the expiration date comes into place. If you guys have ever traded an option, you know it's going to have a strike and it's going to have an expiration, right? So that line in the sand, that's where your strike price comes from. And how much time you have is that expiration date. For example, if you take a chart like this, most people buy call options where the stock has to go up to make a profit on the trade, or they buy a put option where the stock has to go down to make money. And the challenge with buying regular options is that you're battling timing and direction and implied volatility all at the same time, which means you don't just need the stock to go up. You actually need it to go up a lot at the right time, and then you need to make a great exit on the trade. And I always ask, how many of you guys have ever made great trades, but then you don't get out at the right time? So your entry might be good, your direction might be good, but then your exit is actually what hurts you. I'm seeing a whole bunch of chat saying that the overnight option trade hit as well. Awesome. Love it. Another win on overnight options. We'll talk about that shortly here as well. But how many of you guys have made a ton of great trades with great entries, but your exit was not good enough to make you a profit? Anyone been there, or is that just me? Right? That is a major, major challenge with trading, which is why some recent studies suggest 90% of regular option buyers lose money. Wow. 90%. That's a crazy, crazy number of regular option buyers losing money. The way I trade most strategies is almost the exact opposite. Remember, a call option has to overcome that certain area just to have a chance at a profit, and that's called the implied volatility. That's what you're paying for in the volatility. So while you might be entering the trade down here, your line in the sand to make money, where you actually need the price to go, is up here. And you have to time the significant move up with really good timing as well. What I'm doing is flipping all of that around and using a line in the sand wherever I want. And that's really important, guys. When you're trading a debit spread, you can actually pick the line in the sand wherever you want, right? So you're not at a whim of where the market needs to go. You're actually telling the market where you want it to go for you to create a winning scenario. It could be above the price for a directional debit spread with a big ROI potential. You know, this would be like an elite trade or a jump trade where you're making the market move a lot. Or it could be well below the price for a defensive trade with less ROI potential. So this might be something like the income machine trades, where you're getting more conservative below the price. What this means in practice is that if the stock hits the expiration anywhere above this level, the trade is a win. So that's what actually a debit spread, the win-loss scenario in very basic terms, is it has to finish above that level. You're creating your winning zone anywhere above that on a call debit spread like this. A put debit spread with a line in the sand would work the same way, but in reverse. Anything below the profit zone for the trade would be a profit. So the key here is that we're creating a ton of winning scenarios when we choose a line in the sand versus having to get the timing and direction and the exit all right together. Nice. Jack, Linda, more overnight option winners. Love to see it. So in a bullish example with a line in the sand below the price can go up, price can go sideways, price can go down a little. It can even go down a lot and then bounce back and finish above the line in the sand, and we still win the trade. So again, we're talking about more scenarios that provide winning opportunities. Okay, remember the first scenario is a call option. It has to go right in your direction quickly, all at the same time. You have to get out at the right time. All that has to happen. Here, there's lots of different scenarios where you can end up with a winning trade. And here's the cool thing about debit spreads. Whether we nailed the direction and the stock finishes way above the line, way up here, or barely above, all the way down here, or somewhere in between, it actually doesn't matter for a debit spread. We get the full max value in every situation as long as it's above our line in the sand. And there are three main components to building out a trade like this. Where do you put your line in the sand? So where on the chart are you actually trading it? How much time do you give the trade? That's the expiration date. How big of a window of time? And then what is the risk to reward you get with that combination, which I personally think is the part of the combination that most people ignore. Most, trading gurus out there, they kind of ignore the realities of the risk to reward and what the trade-offs are from trading that way. But we want to talk very specifically about that because it's arguably the most important part of the entire structure of the trade. So you could go below price, like I usually do, where you have a 1% cushion or a 3% cushion or a 10% cushion, or you could go above the price with the exact same structure. In either situation, okay, this is important. Either situation, the principle is the same. The stock has to finish above the line in the sand that you're choosing to yield a full profit. In one case, you're starting with the price already above it. Okay, so you're already starting out with the price above it. In the other case, you need the stock to make a directional move to get above the line in the sand. Okay, does everyone see the difference? The reality is the exact same. The market has to stay, or finish above that line. In some situations, you're starting out with it already above the line, so the stock can do nothing. But in other situations, you're actually creating a line in the sand where the market has to make a net move above that line in the sand in order to be above it. The principle is the same. The stock has to finish above the line in the sand at your expiration date, but in practice, how it actually works is different, where one, you're already below it, and the other, you need the stock to make a move. So your next question should be, what does finish mean? Nate, you keep saying it has to finish above the line in the sand. What does that actually mean? Well, that's where your expiration date comes into play. And you can pick any combination of line in the sand and expiration date that you want. And that's going to determine what your profit potential actually is. So these combinations are really where the magic happens, right? Because you're going to choose, where do I want the stock to go and how much time am I giving the stock to make the move? And the combination of those two things is where you're actually going to see what kind of trades and what kind of risk rewards you can make. So you can have a 50% ROI potential if you gave the trade, 7 days and a 1% cushion, maybe a 55% ROI. Or if you actually flipped it and said, instead of having a 1% cushion, I actually wanted to move up 1%, you could flip that from a 55% to 125% ROI because you're requiring a directional move. Or you could give it 21 days instead of 7 days, and now your ROI potential might go from 125% down to 105% because you're giving it a little more time. Or you could be really safe, where you go 8% below the current price and you only give it 7 days to make that move. But you could also give it 35 days, and now you're going to get more bang for your buck because you're giving the market more time to move negative 8%. So why does that happen? Okay, look at this. 7 days, if it moves down 8%, you can make about a 5% ROI on the potential. But if you keep the line in the sand exactly the same, but you trade 35 days away, now the market's going to give you 25%. So it's going to give you 5 times the profit potential, flipping from this scenario, 7 days and 8% cushion, to 35 days and 8% cushion. Why does that happen? Well, because the market's not dumb. It knows that it's very unlikely that a stock's going to move down 8% in the next 5 days. You're almost guaranteed to win that trade. But when you give it 35 days, the market automatically prices in that there's now a higher likelihood that the market is going to move down over the next 35 days, 8% than it would in 7 days. And it's automatically reflecting that in the price of the options. And that's why your ROI and your risk reward is going to change. Okay, so now hopefully you have a good conceptual understanding of building that line in the sand with a debit spread, right? Like You can pick your line in the sand. You can pick your time. You're going to get different ROIs. It's going to have to finish above that line in the sand. But what are we actually doing when we set up the trade? Bob, if you're getting an echo, it probably means you have it open in multiple tabs versus just one tab. So you probably have the opening playbook room open in two different places, and that's probably why you're getting an echo. So a debit spread is an option strategy where you buy one option and sell another option at a different strike price, both with the same expiration date. You pay a net debit, that's a cost to enter the trade, and your risk and reward are different are defined from the start. So you always know how much you can make versus what you can lose right from the initial setup of any debit spread. So for example, imagine the stock's trading at 110. You buy the 109 call for $1.20, and you sell the 110 call for 45 cents. So your net cost is 75 cents per contract, right? Because you bought one, you sold one, you pay the difference. Now, the max value of the trade is $1. So the most you can make, or the most it can ever be worth, is $100 per contract, right? So your max profit, your actual net profit on the trade is going to be $100. That's the max value minus what you paid, which in this case, our example, $75, right? So your return here is the $25 that you can make versus the $75 that you paid, which is a 33% ROI. Let me just pause there. Does that make sense to everyone? You have a price that you pay. Give me a yes in the chat if it makes sense. You have a price that you paid. You have a max value that it can be worth, and you're simply going to divide those together to actually get a real ROI, just like our overnight option that a whole bunch of you hit yesterday. So we paid a certain price. We paid like 70 cents. The most it could be worth is $1. So 30 divided by 70, we're going to have like, a 30+% or 40% ROI. Then we use a target for a portion of that profit, which we'll talk about in a minute. Okay, good. Perfect. So almost every broker will allow you to do what I just described in one ticket or in one trade using a vertical spread. I'll actually show you an example from several brokers here in a minute. Now, for a call debit spread, which is what I'm doing 99% of the time, it's always going to look something like this. You're going to have a current price, where it's trading, and then you're going to set up your buy and call option somewhere relative to where the current price is. In this example, we're saying the current price is 101. I'm buying a $99 call. I am selling a $100 call, and that defined together is my debit spread. Now, the option we sold is what I call the line in the sand. So if you're taking notes, this is probably one of the most important notes to take. When Nate says line in the sand, where the price has to finish, what does that mean? It's the sold call option at the higher price. That is the area that we must finish above to get a net profit. Okay, that's what was going to generate the max profit. But what is the max profit? How do we know what we're risking and what we stand to make? And again, this is the part that I think most people kind of skip over and never really explain in detail, because that just sounds nice to say, hey, look, you made $20 or you made $30 or you made 20%. And they don't really explain how this actually works. So in order to do this, you have to know three things: the max value, what you're paying, and the potential reward. Now, the max value of the spread is always the width of the spread, which means the difference between the strikes. So on a trade like this, where you buy the $99 call and you sell the $100 call, since that's $1 apart, the max value is equal to $1. If we were to instead buy the $990 call and sell the $1,000 call, now those two strike prices are $10 apart. So the max value becomes $10, not $1, because the strikes that we're doing our debit spread are $10 apart. If we were to buy the 270-250 and sell the 275 call, now those are $2.50 apart. So the max value there is $2.50. As long as you know the max value of the spread, everything else should start to make sense to you, right? For example, if I buy the $99 call and sell the $100 call, and I pay 80 cents for the trade, how much profit can I make on the position? Well, we know what the max value is, so now everything should start to make sense, right? Jack and Wayne, you guys are on the ball. We have our max potential is 20 cents. Why? Well, because the max value is 100 minus 99. That's $1. I paid 80 cents up front. So if it becomes worth $1, if it hits that max value, I will have made 20 cents, which is equivalent to a 25% ROI. Okay, Karen, this is the same principle for anything. Whether it's a wrap, whether it's a jump trade, whether it's a defensive trade, does not matter. The math is all going to be the same. The structure is all going to be the same. The difference is going to be where the strikes are and what you pay. But the formula is going to be the same for every debit spread, regardless of whether it's a wrap order or a jump trade or defensive trade or anything else. Same thing on a wider spread, right? If I buy the 272.50 and I sell the 275 and I pay 125, what's my profit potential on that? No, Jacqueline, it is a 25% ROI. So this is actually, Jacqueline, something that a lot of people get wrong. I actually have heard professional traders teach this and get it wrong. That silly little math gets you. So people will say, hey, it's $1 spread and I made 20, so that therefore I made 20%. Do you guys see the problem with that logic? And by the way, I've heard people who have been trading for 30 years explain it this way and say like, hey, I got a 5-cent credit on $1 spread, therefore it's 5%. I got a 30-cent credit on $1 spread, therefore it's a 30% ROI. But there's a major problem with that. They're giving you the full width of the spread, not your risk, not what you actually paid for it. The risk that you actually took on was the 80 cents, not the $1. So you're always dividing your profit potential versus what you paid and your risk, and that's where the 25% ROI comes from. So Jacqueline, hopefully that makes sense. A very, very common misconception that so many people get wrong here when they look at spreads. They do it based on the width of the spread versus the actual risk, which gets really, really wonky when you start doing examples like the next one. Paid $1.25, and so what's your profit potential? Well, it's 100%. So I've heard tons of people say, hey, I got a $1.25 credit, or I made a $1.25 debit, or whatever you want to do based on the 250 spread. So I made a 50% ROI. And you have to say, whoa. No, you made 100% ROI because you only risked the 125. The 250 risk was never in play. And so if you think about it, they run their math on making a 50% ROI, and they think, it has, a 58% win rate, but it's a 50% ROI. That's not profitable. And you have to say, no. You made 100% ROI. So if you can win 60% of the time with 100% average ROI, that's a phenomenal strategy. But they get it wrong because they're looking at the width of the spread instead of the actual risk to reward, the true risk to reward. So hopefully that makes sense. Like I said, this is the part that most people skip over. It never gets explained. It gets missed all the time, even with talking heads and people who should know better. And so hopefully that's a little bit of an aha moment for people. So again, as long as you know the value and the potential of the spread, you will always be able to understand your risk to reward. So with that being said, pop quiz. If I have a massively high probability trade to buy the 230 Apple call and sell the 235 Apple call for a $525 debit, and I'm basically guaranteed to win the trade, should I take the trade? Right? And unfortunately, I've seen people do this. But you guys are right. Why should I not take the trade? Well, because the max value of the trade is only $5. So if I pay $525, I'm guaranteed to lose the trade. But unfortunately, I have seen people put a market order in and pay more than the max value of the trade. But if you have a real understanding, you won't be caught in that trap. You won't just be following an alert blindly and pay too much for a spread. You'll know, hey, looking at this, the max value is $5. So I'm never going to pay more than $5. In fact, I probably won't pay more than $4.50 because I want to have at least 10 or 12% ROI, even on a high probability trade, right? So hopefully that is starting to click for you guys. All right. So now you should have an idea of the conceptual structure, how we want to set that up, and the function of the options themselves. But you still may be wondering what actually happens when a stock finishes above the line in the sand. So we've already covered a lot of math. Who's ready for some more math as we get into what actually happens? Because this is another question. I get this one in my email almost every day. Okay, Nate, you said I'm going to win if it finishes above the line. How do I win? What the heck actually even happens under a winning scenario? So we have all these great scenarios where we can make money. What actually happens? Well, like I said, anytime the stock finishes above our line in the sand, we win the trade. But what does that actually mean? Well, let's assume we set up the trade like this. We buy the June 27th $100 call, or sorry, $99 call, and we sell the June 27th $100 call. So basically, we set up the trade over here with our line in the sand below price. So we have a 2%, what I call a cushion on the trade. We always use the same expiration date, June 27, June 27. And we're always using the same type of option. Both are call options. And when any of these outcomes occur, the trade expires in the money. What does in the money mean? It means above that sold call option and above that bought option. So both are in the money, right? Here's what that means. Our ability to sell the stock at $100 is exercised or assigned. You might need to use the word assigned. And our right to buy the stock at $99 exercise as well. So what happens when these both finish in the money is that your right to exercise and your obligation to sell both happen on the same trade. So all we have to do is a little basic math. What happens if you buy a stock at 99 because that's what your bought option, and then you sell the stock at $100? I mean, unfortunately, this is not rocket science on this particular math equation, right? I think everyone can get this one right. If I buy a stock for $99 and I immediately sell the stock for $100, what just happened? If I buy 100 shares, if I buy 1,000 shares, all the same, you make $1 per share, right? And that's actually exactly what's happening when a debit spread is exercised. What it's doing is it's giving you the stock at $99 where you buy it, and then it's selling it right away at $100. And so in practice, that's exactly what a debit spread is doing. So you're making the full value when these both exercise. Then you certainly just subtract what you paid, and like Christine said, maybe some fees, but that's where you get the net profit. So you make the full dollar minus the max value of the spread you create. And the best part, this happens automatically as long as your trade finishes above the line in the sand. So if you guys are wondering, okay, how do I get the broker to exercise it? What happens here and there? Well, this happens automatically if you let it expire above the line in the sand, meaning you don't have to do anything, no exit or trade management to collect the full max profit. All right, so we just covered the conceptual idea of how you can set up a spread and different risk rewards. We just talked about how to, actually understand the function. Then we talked about the risk to reward, and then we talked about the actual what happens when it makes a expiration above that level, the actual exercise. Hopefully that now all makes sense to everyone, at least at a fundamental value. Now, at a fundamental standpoint. Now, you might need to still make some trades because in my opinion, it doesn't really start clicking until you've made a few trades, you've managed a few trades, you've watched them work out. But hopefully you guys at least have a good framework. Give me a yes in the chat if you have a better framework for debit spreads now than you did 30 minutes ago. Hopefully the answer is yes for everyone in the chat. All right. Good. Okay. Perfect. So what you will see me do is go back and hammer these core ideas over and over and over again throughout time. The line in the sand, the risk rewards, understanding the max value of the trade, all that sort of stuff is what I'm going to hammer over and over again with all the different trade structures that I trade. So what I want to do next is I actually want to jump into the brokerages and just do a couple dummy trades for you guys with real money. So not really dummy, but one contract example trades. And then I want to point you to some other really important topics, like why we often use early exits. I think one of the biggest advantages. What about early assignment? Green Farm Cat just asked that question. What about early assignments? Talk about. I'll point you to that. Why not credit spreads? And I think one of the biggest myths in all of options trading. And then really importantly, why I never, ever, ever use a stop loss, even though some of you get mad at me sometimes for not using a stop loss. I'll never do it on a debit spread, and I'll point you to that a little bit as well. But before we get into that, let me walk you through the actual trade here on a couple different brokerages. So let me stop sharing this. And what I will do is I will actually pop open my brokerage account here. And I'll start sharing that screen from the trade menu. Let me just share the whole window with you. You should see that. All right, folks, that is now sharing right there. And you guys should actually see my Thinkorswim platform now. All right, so like I mentioned, almost every single brokerage will let you actually do this in one ticket. So most of them will have something like a vertical pre-built option here. So regular options would be single, but then if you flip to vertical, like I do on Thinkorswim, you should be able to see that. Now, I don't know if I can write on my screen here. Can I write on the screen? Do you guys see it if I write it? I don't think it actually shows up, unfortunately, because of the way the sharing works here. But hopefully you can follow my cursor well enough to see up here is where we're going to choose the vertical versus all the other kinds of options. And that's what's going to pre-select these debit and credit spreads. Now, when you look at the actual framework of the trading options, what you're going to see is actually exactly what we just described. We talked about choosing your time frame. That's the expiration date, right? You can choose any time frame you want. You can do 2 days, 9 days, 16 days, 23 days. This is particular on Apple. And then within the time frame, you can choose, do I want to be below price or above price? And that's where your strikes are. The difference is these are going to be preset for you. So if I click over here, this is the 202.50, 205 Apple option, and I click that, it's actually going to pre-select buying the 202.50 and selling the 205 versus me clicking those options individually. Okay? So we could do an example of one of these trades here if we want. We could go to SPY, and I'll show you an example. So let's talk about if we wanted to do a very extreme option. Well, if you want to do a very extreme option, what you would do is you would give the option very little time, but you would require it to move a lot. So I could say, listen, I want SPY to move $5 today by the end of the day and go to the 634, 635, and you can see that option would cost me a whopping 1 penny. Why? Because that time frame I showed you earlier. If you give it 0 time and make it move a lot, you're going to have a very cheap option. If you give it lots of time, it's going to be a little more expensive. So I could trade this 634, 635 for about 1 or 2 pennies. So let's just to give you an example, I'll put that trade in, but my max loss would be $20 and my max profit would be $980. Why? Because the probability of the SPY finishing above 635, which would be our line in the sand here, is an incredibly slim probability. So let me go ahead and send that out. And there you go. I just got filled on a 634, 635 ridiculous spread that I don't recommend you guys taking for a zero expiration, where the market would have to go up almost a full percent there over the next, what would it be, 5.5 hours in order to get above my line in the sand, right? So that's an example of an extreme. Now let's go to Tasty Trade here, and I will give you another example of doing this. Let me see. Actually, I think I have to switch my my window here again. Let me go to this. And I will just share the full screen with you there. Okay. So now I'm going to show you on Tasty Trade. I just put about $2,000 in a Tasty Trade account so that you guys can see that. Let me just refresh, because I had a whole bunch of questions from people who said, hey, I want to see this on a Tasty Trade account. So I put about $2,000 in here so I can show you trades on this. So same function, right? You go over to trading. You would pick which asset you want to do. See, it's asking me if I want to tour because it knows I still have no idea what I'm doing in Tasty Trade, but that's okay. And then under the trade tab, we would have the same kind of options, right? We would have what expiration do we want to choose? And then what strikes do we want to choose with that? Now, Tasty Trade works a little bit differently with the strategy option. You can see here underneath strategy, you can pick all kinds of different things. This is already pre-set up to a vertical. That's the one that it automatically sets up for you. And you could set it up as a short call or a short put or a long call, which would be a buy debit spread, what I typically do. Then what I could do, if I go ahead and say, let's just for fun, let's set up the same trade. I'll let you guys guess. So let me do, instead of doing one day today, let's go to September 5th and set up the same trade. And you guys guess. The last trade cost 2 pennies. Let's go to the same expirations. What do you guys think the difference will be going from one day to 1 month? Do you think it'll be twice the cost, 3 times the cost, 5 times the cost? How much more do you think we'll spend on the extra time that we're giving it? Well, John, it's only a dollar spread. So the most it can be worth is $1. Keep that in mind. So let's see. What did I just trade here? I forget already. I traded 634, 635 for 2 pennies. Okay, so let's go ahead and set this up and go down to the 634, 635. And you guys can see this is going to cost us now about 30 times the price. About 30 times the price buying 1 day of value versus 1 month. Why? Well, like I said, the market's not dumb. It knows it's very unlikely the SPY is going to move up 1% today, but it's pretty likely the market can move up 1% over the next month. So we are paying for that extra time. Ted, you're right, but there is a curve there, because I'll bet you if we go out 3 months, it'll be more expensive, but it won't have nearly the same ratio. In other words, it won't be 90 times the price if we go out, because there's a shallowing curve. Let me show you what I mean. So instead of September 5th, let's go to January 2026 and do the same thing at the 6th. Oh, I can't do single dollars. All right, hold on. Let me go back to when I can do single dollars on to give you an exact example. Let's see. Do we have singles here? No. Do we have singles here? No. Let's see. Do we have singles here? Yes. Okay. So let's go to the 634, 635. You can see it's barely more because the curve flattens and the time doesn't matter nearly as much once you get out further in time. So the short dated, going from 0 days to 5 days to 10 days to 30 days, is a much more expensive option. But as you get over time, the pricing really flattens out. All right. So hopefully that makes sense. Guys, by the way, this is a great way to learn debit spreads. Literally coming into the options chain, looking at different expirations, setting up theoretical trades, and looking at them in practice is actually a great way to learn, and I highly recommend it. So let's go ahead. Let's set up our same trade, but go out a month, and then we'll track them. We'll keep an eye on them together. So this one's going to be about 50 cents. This one is less of a donation because it actually has a decent chance of winning. I'll set that, and now that is a working order attempting to be filled. Okay, so that's on Tasty Trade. Now, let's go over to Robinhood because I also put a couple $100 in Robinhood because I got lots of questions about how do I set it up in Robinhood. So I'm throwing money at different accounts so you guys can see different examples. So let's do the same thing. Let's go to SPY. Let's go to Trade Options. That's where Trade SPY Options. That's where we see the same exact thing, right? A little bit of a different format here where your expiration, your time horizon is going to be up here, and then your strikes are going to be down here. Now, Robinhood has two options. You can use today's expiration. You could buy one and then flip over to the sell side, and you can grab another one and set up the trade like that, where it will do it for you in a similar structure. Or you can use what they call their builder option. And their builder option is going to be the one that pre-selects them for you. So again, vertical spreads, we are looking at call debit spreads. You click call debit spreads, and as you can see, it's going to set these up for you. 622, 623, 633, 634, etc. It's going to build these for you, right? So you can also, by the way, choose your strikes, where you can go to wider or shorter strikes. Let's go to tomorrow's expiration and do a defensive one. I'll show you how much more expensive it gets if you go below the money. So the current price is $6.30. If we come down here and we go $4 or $5 below the price, you can see it's going to be a lot more expensive option. You know, we paid 2 cents for one way out of the money, but we're paying, 84 cents or so. Looks like more actually like 85 cents maybe for one out of the money. So again, this would be one where you're getting below your line in the sand. And that's how you would submit it using the builder. So that's 3 different brokers, 3 different debit spreads with different times and structures, but all using the same concept with different parameters. And that's really what I'm hoping for you guys to get more and more comfortable with as we go along. I will, teach you guys strategies, obviously, give you as big of an edge as I can, but hopefully over time, oh, look, I'm down $1 on the day. My equity curve doesn't look very good. But hopefully over time, you guys will get more and more comfortable with those structures and be able to set them up and use them in a way where you understand what you're combining with different, risk rewards, different time frames, all that kind of stuff. Okay, now another thing that I want to mention, folks, is if you want to learn some of the deeper nuances here, which I hope every single one of you want to do, you want to join Opening Playbook. That's the $1 lifetime subscription. The reason we charge $1, we wanted to make it free, but they said to put it in the members area, we had to charge something. So we charged $1. That's where you're going to get all of those other things like I mentioned. So you're going to get the why I use early exits. You're going to get the why I never use stop losses. You're going to get the calculators that show you how to set this stuff up. You're going to get the recordings of previous sessions. You're going to get the trade tracker. You're going to get all the different things that help you utilize the foundational trades that we talked about today if you are a member here for the $1. So again, I would give it to you for free if I could. I can't. We had to put it in the members area. That means we had to charge the least amount we could. And so we had to give you, the $1 order form to secure your access inside here. So I do recommend that. Dave, I don't know if we already have like a quote unquote CTA pre-set up for the opening playbook VIP. We should probably get one, but for now, maybe we could just grab that link and post it in there for folks. If you want to join that $1 VIP, that's where you'll get all of that. So I'll give Dave a minute to grab that link. We'll post it in there in a couple different places for you guys. But before we move on, it already is 10:50. I promised we would talk about overnight options. So the first thing I'm going to ask in the chat, guys, let me know if you hit your target either today or hopefully both. If you hit your target on overnight options yesterday and today, one with a down day in the market, and so far today with an up day in the market. Thank you, by the way, for all of you guys who sent me those emails. That was awesome. We are hitting these targets on a really consistent basis on overnight options. Kevin made $1,800 today. Diane both days. Debbie both days. Green Farm Cat both days. Elena both days. Charles, Silvana. Okay. Deb said not yesterday. Okay. Sharita said yesterday. Ron said yes. Kevin said yes. Jerry said yes. Brandon said yes. 17.5. Nice. Yes, both. Okay. So what we're going to do is, okay, Katura both days, Browner both days, Edward both days. What we're going to do is we're going to give you another opportunity on overnight options, because I don't know if you guys saw this. I actually had Blake go live. Did anyone join Blake in Evening Edge yesterday? I gave Blake some notes yesterday going through that trade. Hopefully it was valuable. I wasn't able to join live, but I wanted to show how crazy it was, how ugly the day yesterday looked, and we still hit the target on a bullish trade, which is, even though I've been doing this for over a year, it still kind of blows my mind every time we hit those winners on really ugly days because we're in a bullish trade. So that puts us like 22 for the last 24, racking up a lot of wins. And I still had tons of people emailing, even after we talked about it yesterday in opening playbook and after Blake saying, Nate, I'm still not in. How do I get in on overnight options? So let me have Dave also share that. Ton of you guys in here already have it. You're already trading with me every day. But if you guys are not yet in overnight options, we're going to play that one more time for you.
You guys know this. This is really important.
Give you the opportunity.
The profits and performance shown, they're not.
Sorry, Dave. I didn't mean to cut you off. Go for it.
You guys know this. This is really important. The profits and performance shown, they're not typical. We don't make any future earnings claims, and you may lose money. Winners and losers are a part of the game. Now, the majority of trades today are from back-tested data, unless otherwise stated, in order to demonstrate the potential of the system. Now, on the back test, the average return is 5.3% overnight. So in 24 hours, you get to do that multiple times per week with an 89.5% win rate, and the average winners being 16% overnight. Now, every overnight options trade, if you're starting with 5K, targets right around $823 every single day. And that's overnight. Again, this isn't day trading. You don't need a huge account to do this. We're talking about overnight gains here, $823 per trade. And every example is based on that same starting stake unless otherwise stated. However, you don't need that much to get started. The average cost per trade is less than $100. So you can be like Steven. He just mentioned he started with $150 and then over about 10 weeks grew his account to $3,200. So you can start small and scale over time. Now, obviously, we can't guarantee any specific future results. There's always a high degree of risk involved in trading. You can go to the website for more information on that. Now, my name is Graham Lindman, and earlier this year, I received an urgent call from options expert Nate Tucci claiming that he discovered a new way of trading. It's one that allows us to place a quick trade, wait no more than 2 weeks, and when everything works out, watch as the position automatically closes out with right around $1,250 more than 70% of the time. Now, after reviewing the data and placing a few of these trades for myself, well, I immediately flew Nate down to my home in sunny Florida to cut the ribbon on his all-new automated options. You may have heard of it before. Now, if you were there at the original groundbreaking ceremony, chances are you're loving the results of the live published trades so far because they're even better than the original backtest. Let's take a look here. Art, a retired Navy vet, said, I've been able to win 5 out of 6 trades so far. Total return profit of $4,650. Really enjoys the ease of placing these trades and the surprise you feel when a trade closes. Thank you, Nate. What about Carlos, who said, with 9 trades and minimal risk, my account has grown almost $5,000. Nate has been a great coach and a humble human being. Or Richard, he said, I took 5 trades, 5 automatic wins, total of $4,434. Love that I can set it and forget it. And guys, there are dozens of more stories, actually probably hundreds more. There you can see Q, Ed, Deb, Chad, everyone. Look at this, Sylvia, Steven, Sally, even Jeff said up $17,000 in the last 6 months. Now, as much as I'd love to spend today bragging on Nate's automated options, which are currently hitting with an 82% win rate on live trade alerts, well, this broadcast actually isn't about the fan favorite automated options. No, today we're talking about something that's much, much bigger. You see, thanks to a new set of data, an overnight market phenomenon that dates all the way back to the 1990s, we're now able to amplify those types of automated options results that you just saw, but do it in just a fraction of the time. As a matter of fact, all we have to do is place a quick trade before the markets close. That includes today. And if it works out, watch as it automatically closes out less than 24 hours later, overnight. Now, we're always targeting right around $823 on each trade. And the best part is